Hi friends, today I will discuss about finding investors in the early stage of startups. Finding investor for an early stage startup is one of the most challenging jobs in the entrepreneurial journey. But now the startup ecosystem in India has become very strong and startups have many opportunities for funding. Finding an investor for one startup in today's time has become relatively easy as a number of options are available. However, this road still might not be as easy as one might face rejection to. But it's important to rise above them, learn from the mistakes, and improve oneself. Soon the right investor will come along to help to take the business to the next level. So what are the sources of funding? During the pre-incubation stage, a prototype grant is required for a startup. Prototype grants are available during this phase from different incubators. Different ministries have different schemes such as Prayas, EIR from DST, DIG from BIRAG Department of Biotechnology, Tide Scheme from MEITI, Ministry of MSME has also some schemes. Then incubation phase. In this phase, seed fund in equity or debt funds are available from different incubators. Now, Startup India seed fund schemes are also available through incubators. The amount is 25 lakhs to 50 lakhs, but can be 1 crore in exceptional case. After that, the angel investment stage will come. The average seed funding amount in angel investment in 2020 it is 2.2 million. Angel investment normally range between 15,000 USD to 2 million. Then VC Series A, VC Series B, C, D, and like on. So Series A rounds range approximately $2 million to $15 million. And Series B it is $33 million. So as an entrepreneur, it's your responsibility to research the investor in advance to check whether their fund matches what you are seeking. If you seek investor randomly, the results would also be random. Or still, you would end up wasting everyone's time in the process. So early stage startup, they must focus on they must decide based on only 2 to 3 areas of focus. Most early stage startups do not have proven business model. As a result, it is difficult to predict future revenues and cash flows with any certainty. Early stage investors focus a lot more on the team and market. These are probably easier to evaluate and to understand. Understanding is that if it is a solid team playing in a good market, even if they have the very good product, but if it is a wrong team, then a couple of times they can also that particular startup will fail. So the team building is a very key point for a early stage startup. Here you can see that the different nature of different types of fundings like equity, debt, and grants, and what are the sources of these fundings and other details. It is available through the Startup India site also. You can go through that. So how to prepare a pitch deck for early stage startup? The initial pitch presentation, this could be a PPT or PDF document, should not be more than 12 to 15 slides, covering the points mentioned here. At this stage, details and numbers are not necessary. At the preliminary stage, the review committee as well as investors are keen to understand if the problem and solution is real and it has commercial ability, if the team has complementary skills or not. So a pitch deck should cover a cover slide, then team, highlight what each member of the team will do in the venture, and why he or she is best suited for the role. Indicate if the person is a co-founder or founding team member or an employee. Against each indicate the percentage of equity held, currently or planned if not yet distributed. Very important, as investor always want a team with a complementary skills. Then third is the explain why your customer need your solution. Mention what they are currently doing and how your product or service is a better solution. Then fourth is the highlight the uniqueness of the product or service or technology and not the technical details for each feature in the product or solution or service. This is about, then fifth point, you can say the business model. This is about how you will make money from this business opportunity. This is not the Excel sheet. In a simple terms, this is about who will pay how much, and to whom you will sell your product. Then sixth point is the what is the total addressable market or TAM it will cover. Then seventh point is what have you achieved so far, product, customer, revenue, etc. Whatever, all these things you can mention. Include photographs if possible. For example, if you have physical stores or products that you manufacture or different pictures. Then point 8 is the competitive landscape. Who are currently or in future likely to compete against your product or service, and what is your plan to win this battle? Explain why are you better than your competitors. Then ninth is the summary of your business plan Excel sheet for 3 years. Note the detailed Excel sheet not required. Just key figures at annual level up for the 3 years are sufficient for the preliminary evaluation. If there is sufficient interest from the investor in the venture, they will definitely evaluate your Excel sheet and business case in detail. Break up your cost in the CapEx and OpEx if possible. In OpEx, highlight major cost components, salaries, marketing, etc. Cover the unit economics. How much revenue do you get per transaction or per customer? How much does it cost you to service that customer per order? Then point 10 is the describe what is your ask, means to how much money you want to raise and it's a planned uses. Then point 11th is the table of current equity holding. How much money have you invested? Mention previous investment history if possible, including year, amount and investor. Then 12th is the exit point. So what angel investor are looking for? My basic advice is keep your pitch very authentic. Tell your story very well in a very well manner and in a manner that investor can understand your pitch. Don't be too much technical or too much technical. Don't describe. If they will ask, then you can say. The vision of the founder and their components to the customer is a strong motivating force for any business. If your team is not efficient, there is no point of having a great startup idea. Angel investors generally like to interact with the founder's team and management team to access their quality. Scalable business means when a business has the potential to multiply revenues with a minimal incremental cost. So investors are looking for the scalability of your business. Then fourth point is the size of total addressable market. If your product or service is appealing to a large population or not, that is, it caters to a large customer base, investors would be interested in investing in your ideas. Then fifth is the traction. Business traction is nothing but having the momentum or sign of growing business, such as having a measurable customer base, growth in sales, etc. So higher the traction, the more investors are attracted to the organization. Then sixth is the reasonableness in evaluating your business plan. Be genuine while estimating your financial numbers on your business plan. Don't do overvaluation as well as undervaluation. Do proper research to get a reasonable estimation in the valuation. Then seventh point is the valuable exit strategies. Angel investors are patient and willing to invest in the long term. Though profit is not their main motive, they expect some sort of return on their investment. Therefore, it is obvious for them to look for an exit strategy to reap their benefits. The most common exit strategy in sales of shares to the company's principal founders. Other common thing, selling the business to strategic buyers. Some startups will try to convince their angels for an IPO. So thank you, friends. In the next video, I will talk about the different funding opportunities available through different government schemes for the startups. Thank you.